A shock report has revealed a startling truth. UK house prices have shown no real growth in the past 20 years. Despite the headlines and the constant talk of a booming property market, the reality is far less rosy than many believe. For generations, owning a home was seen as a guaranteed path to wealth and security. Parents encouraged their children to get on the property ladder, believing it was the safest investment one could make. But when you strip away the effects of inflation, the average UK home is worth no more today than it was 2 decades ago. In real terms, the value has simply stood still, defying the expectations of millions. This isn't just a temporary market correction, it's a fundamental rewrite of the British economic dream. The idea that property always goes up is being challenged like never before. Many families stretch their finances to the limit, convinced that house prices would keep rising forever. But for many, that prosperity turned out to be a mirage, leaving them with high debts and little real gain. The money you get for your house today, after adjusting for inflation, buys about what it did in the mid-2000s. The dream of easy wealth through property has faded for many. The implications are profound, from retirement plans that relied on rising house values to consumer confidence and spending. The very foundation of financial security for millions has shifted. The era of ultra-low interest rates is over. Rising borrowing costs have exposed the reality that the market was propped up by cheap money, not genuine growth. Recent nominal price falls are just the market catching up to years of stretched affordability. The correction is not just in numbers, but in expectations and lifestyles. The great stagnation is no longer hidden in data. It's being felt by real people, in real homes, across the country. Hopes for easy gains have been replaced by anxiety and uncertainty. The next chapter for UK housing is being written now. It looks nothing like the last, and for many, it's time to rethink what home ownership really means in modern Britain. In the UK, a house is never just a house. It's a symbol of stability, success, and even identity. For many, owning a home is seen as a major life milestone, a sign that you've truly made it. The bricks and mortar represent more than shelter. They're a source of pride and security, passed down through generations. For millions of people, their home is their largest financial asset, often dwarfing their savings or pensions. Collectively, UK homes are worth trillions of pounds, making the housing market a cornerstone of the nation's wealth. When house prices move, the entire economy feels the impact. Rising prices can make people feel richer, encouraging them to spend more, while falling prices can make families tighten their belts. Consumer confidence, spending habits, and even job security are all influenced by the housing market's ups and downs. Rising prices create what economists call a wealth effect. Homeowners feel more secure and optimistic, which boosts the economy. But when prices fall, confidence is shaken, spending slows, and the effects can ripple through every sector. This powerful link between property and prosperity is why the government and the Bank of England monitor the market so closely. They know that a sudden drop in house prices can threaten financial stability, while a boom can fuel risky borrowing. The housing market also drives a growing gap between generations. Older homeowners have seen their wealth soar as prices rise, while younger people struggle to afford even a modest home. This divide shapes not just family finances, but the future of entire communities. This generational divide influences politics and society, with homeowners forming a powerful voting bloc. Their interests often shape government priorities, making housing policy a hot topic at every election. To keep the market stable, governments introduce policies designed to prop up prices and avoid economic fallout. From tax breaks to help-to-buy schemes, housing is always at the center of political debate. Our obsession with house prices is not just personal, it's deeply political, woven into the very fabric of British life. It shapes our dreams, our anxieties, and our national conversation. The stakes are high, and the consequences ripple far beyond bricks and mortar, affecting every corner of society and the future of generations to come. To understand today's crisis, look at the relationship between wages and house prices. In the 80s and 90s, homes cost about 3 to 4 times the average salary. Challenging, but achievable. But from the late 90s, house prices surged ahead of wages, fueled by cheap credit and market optimism. By 2008, the average home cost over 7 times the average salary. Even after the crash, the ratio stayed high. Now it's around 8. For today's buyers, homeownership is twice as hard as it was for their parents. The market has become disconnected from the real economy, propped up by easy credit, not earnings. Now, with cheap money gone, the high price-to-earnings ratio limits future growth. Prices can't rise much further without wages catching up. A scenario that looks unlikely. This is the backdrop to 2 decades of real-term stagnation. House prices are ultimately set by what people can afford, driven by income and mortgage costs. For years, banks kept lending in check, but in the late 90s and 2000s, they relaxed rules and offered bigger loans. Easy credit decoupled house prices from wage growth, fueling a debt-driven boom. Rising prices made banks more confident, creating a self-reinforcing cycle. The 2008 crisis ended this as banks tightened lending and prices tumbled. The Bank of England slashed rates and pumped money into the economy, reviving prices. But this only deepened the market's addiction to cheap debt. The fundamental problem, the broken link between wages and prices, remains. Without real wage growth, the market's foundations are shaky. Inflation is the silent thief of wealth, eroding the real value of your assets. We talk about house prices in nominal terms, but that number hides the truth. A home bought for $150,000 in 2005 might be worth $275,000 today, but inflation means you're not actually richer. Adjust for inflation, and the real value of UK homes has barely budged in 20 years. High inflation in 2022 and 2023 slashed real values, even as nominal prices barely dipped. If your house price didn't rise with inflation, you lost ground. The modest nominal falls have masked a much bigger real terms crash. The average house today buys what it did in 2005. Nominal gains have been wiped out. The illusion of growth is gone. The reality is stagnation. Homeowners are waking up to a sobering truth. The UK housing market is a patchwork of winners and losers. London and the southeast saw real terms gains, fueled by global demand and limited supply, but this made them the most unaffordable regions, locking out many buyers. In contrast, parts of the north, Wales and Scotland have seen little or no real growth. Some are still below their 2008 peaks. Regional inequality has deepened, widening the north-south divide. The pandemic briefly shifted demand to rural and coastal areas, but rising rates have reversed some of those gains. Expensive markets are now seeing the biggest falls, while affordable regions hold up better. The regional picture is as divided as ever. Where you bought has defined your financial fate. To really understand what's happening in the UK housing market today, it helps to look back at previous downturns, specifically the early 1990s crash and the 2008 financial crisis. Each of these periods had unique triggers and consequences, but they also offer important lessons for what we're seeing now. The crash in the early 90s was mainly caused by a sudden spike in interest rates. Mortgage payments soared, and many homeowners simply couldn't keep up. This led to a wave of repossessions and a sharp, painful drop in house prices that took years to recover from. Fast forward to 2008, and the story was different, but just as dramatic. The global credit crunch meant banks stopped lending almost overnight. House prices fell by around 20% in just 12 months, and the entire financial system was shaken to its core. However, the recovery after 2008 was surprisingly swift. The Bank of England slashed interest rates to record lows and pumped money into the economy through quantitative easing, which helped revive the housing market much faster than many expected. Today's downturn is different. It's a mix of both past crises. Interest rates have jumped to fight inflation, making mortgages more expensive, but banks are much stronger now and are still willing to lend, so the system isn't seizing up. Instead of a dramatic sudden crash, we're seeing a slow-motion correction. House prices are grinding down gradually, not plummeting overnight, and the market is adjusting in a more controlled way. A key difference this time is the strength of the labor market. Unemployment remains low, and lenders are showing more forbearance, working with borrowers to avoid mass repossessions like we saw in the past. Many sellers are holding out, refusing to accept lower offers. This has led to a shortage of homes for sale, which is helping to prop up prices even as demand cools. The result is a stagnant market. Fewer transactions, less movement, and a hidden real terms crash as inflation quietly erodes the value of homes. The pain in the market is less visible than in previous crashes, but for many, it's just as real. Homeowners may not see huge price drops, but affordability is still a major issue. The UK housing market is now stuck in a prolonged reset, with uncertainty lingering and no quick recovery in sight. Let's make this clear. UK house prices have gone nowhere in real terms for 20 years. In 2005, the average home was $160,000. Today, it's $280,000. Adjust for inflation, and those numbers are almost identical. Your house today buys what it did in 2005. Nominal gains, but no real increase in wealth. The journey: a boom, a crash, a slow recovery, and now, the gains wiped out by inflation. The real peak was 2007. We've never surpassed it in purchasing power. For millions, the property dream has stalled. The only real benefit has been paying down the mortgage, not asset growth. The capital gains were an illusion, undone by inflation. It's a fundamental reset of what property means for wealth. The future of UK housing depends on four forces: interest rates, inflation, wage growth, and supply. Higher mortgage rates cap affordability, making rapid price growth unlikely. For real growth, wages must rise faster than house prices, something that will take years. Low, stable inflation would help, but if it stays high, rates will remain elevated, keeping prices under pressure. The biggest uncertainty is inflation's path. Chronic undersupply of homes props up prices, even in downturns. Buyers still face competition for limited properties. Sellers know demand persists. Without a major house-building push, affordability won't improve. The market's future is a slow grind, not a sudden boom. The era of easy gains is over. Now it's all about fundamentals.